There's not much that can take the market higher right now. That's the reality. That's the logic. But by dollar cost averaging in a declining market, you're always going to win. You know, even if you're at a loss, folks, a gain or a loss, right now is still one of the best times to look at doing this and getting into a bridge strategy. You are the best steward of your money, folks. Every one of you, not your advisor, you. You care more about your money than anybody, which is why we're always teaching you how to be the bank, why we're teaching you how to take back control of your money. Welcome everybody to another week, another wealth webinar. It is November 1st, 2023. In about 1 year from today, we are going to actually be in a completely different time, a different environment, because there's an election coming. Dude is running against a whole bunch of other people. So we're going to see what happens to Dude in the election, and it's going to be pretty interesting. But the reason I bring that up is not because I want to talk about Dude or Trump or any of the other candidates running for presidency. I want to talk about it because things are going to change. Things are going to be different. Things are going to be turbulent. It's going to be an interesting run up. It's going to be an interesting year. And during that year, we are all faced with where we're at right here, right now. That's what we can only focus on, is the now. You can't change what's going to happen in the future because it doesn't exist yet. And you certainly can't change what's happened in the past. The Dude did a good job of messing some things up, but we can't change any of that. But we can change what we do, what we prepare for, how we react. And that is all we can control. Just remember the serenity prayer. So I thought today what I would do is kind of almost a preview of what the 3-day training is going to be about, but to give you some serious golden nuggets to prep you, to get you thinking about what you need to be doing now in things that you can control. Because when we get closer to that time, who knows? I mean, are we going to be in World War III? Is there going to be riots in the street? Are we going to be in a civil war? I mean, those are doomsday kind of thoughts, but these are things that people say to us. Are we going to be faced with a digital dollar? And is the stock market going to be completely falling apart? And after the stock market falls apart, it's always this way. The lagging indicator called real estate will start to diminish and will start to deflate. And everything else comes along with that. I don't know. If you follow history, which again, we can't change the past, but it does give us a guiding light. It gives us a reference point to kind of look back and say what other periods of time are similar to this and what potentially could happen. Now, in the 3-day training, one of the, I think, most valuable things we're going to be doing, the whole 3 days is going to be amazing. And also, so you all know, the 3-day that we're doing Friday, Saturday, Sunday is different than any 3-day we've ever done. So day 3, we've got some rock stars coming on talking about some opportunities that none of you will ever be able to get into unless you're around this campfire. Now, we just got back from Las Vegas. We had the Money Multiplier experience out there where 26 unbelievable human beings got to spend 3 days with us racing cars, going to the Beatles show, just hanging out and doing really cool things. But we got to know each other well. And we also got to hear about unique opportunities out there that only 26 people got to hear. Now, today, as of right now, I get to share some opportunities with 98 of you. This weekend, I get to share it with, right now, about 200 people. So you see how this works. We go from 26 to 99 now to 200. We're starting to really make a mark. We're starting to really change people's lives. This weekend, so outside of the opportunities you'll learn about day 3, day 2, you'll learn about protection strategies. Day 1, Craig, myself, Stephen, and a few others, including one guest speaker at the end of the day, which I know a lot of you want to hear about. You want to hear about infinite banking concepts, but you want to hear about the future for that, which, yes, we can't control, but what we can do is lead the way into an uncharted territory called blockchain. So you're going to hear from someone by the name of Cole Snell at the end of day 1, which is Friday, about the future. You're going to see how this group of unbelievably talented individuals, and I'm blessed to say that I am part of that group, part of that movement, where we're going to basically be able to offer IBC, the infinite banking concept, with all the things that we enjoy in the United States to the world, even though the world doesn't have the infinite banking concepts or the product that's needed, the whole life policy. They don't have that in other parts of the country outside of North America. But once we fulfill what we're going to do, we will, because blockchain will allow us to take that luxury of what we have here in the States across the country, across the world. And not only that, you'll be able to do it in lightning speed. The whole idea here is all of you hear me talk about treasury bonds all the time. You hear me talk about them more now than ever before. And you're going to hear me talk about them day one of the 3-day training. But you're going to hear me tell you a concept and teach you a concept. Craig and I are going to show you something that never in all the years that I've been doing this, which is 20 years now, all the years as a financial advisor and all the years I've done IBC and taught this, never once have I been able to show you what you're going to see Friday because it never worked. It couldn't work. People ask all the time, could I do this? And I say, I probably wouldn't. It just doesn't work. But right now, because of Fed actions, because of things going on in the economy, we have a strategy that this might be the only time you will ever hear me talk about it. This might be the only time that it will ever work in history. It's going to be laid out to you in a 5th grade level on Friday, step by step by step, on how you all can apply this strategy. And here's the best part about this strategy: completely risk-free. It is a growth strategy, an income strategy, and a tax strategy, all wrapped into one, risk-free. I mean, come on, have you ever heard me say that? Outside of the whole life's being guaranteed, but have you ever heard me talk about an investment that's risk-free? You've never heard me talk about that, because really it doesn't exist except for one place. And I'm not going to get too into that. But when you look at the institutions, you look at banks, you look at big institutional investment banks, you look at big institutions, that are in Wall Street. Where does their safe money go? You already know this. Treasury bonds. But what are the problems with treasury bonds? There are 2 major risks with treasury bonds. Number one, time risk. So if you buy a treasury bond for 10 years, you got a 10-year window that essentially you have to hold it to maturity to get 100% of your money back. That's time risk. Okay. Do you have to hold it for 10 years or 30 years? No, you can sell it, but that's when it matures is when you're guaranteed all your principal back. Okay. Can you get your principal back before that? Absolutely. But it's market-based, because the second risk is interest rate risk, which is the single biggest thing. It is the single reason why Silicon Valley Bank went defunct, went insolvent, was because of interest rate risk and also time risk. So if any of you just need a recap of Silicon Valley Bank or Signature Bank or Republic Bank or any of the other ones that you didn't hear about because they were saved by the bell, and the bell was the Fed saying, hey, what we're going to do is we're going to give you some money. Just let us take your treasury bonds as collateral. We'll give you a short-term loan at a low interest rate. That matures here pretty soon, just so you know. They'll extend it. They'll kick the can. But that bank, Silicon Valley Bank, went defunct because what happened is the only money banks have to secure your money is called Tier 1 capital. Okay, Tier 1 capital, which is about 10% of all the money the bank ever has in deposits. So you give a bank $100, they have to take 10% of that and put it in Tier 1 assets, which have to be guaranteed. So what are the 2 assets that are guaranteed, folks? Who can tell me what are the 2 assets that are guaranteed, where banks, traditional banks, Bank of America, Wells Fargo, all of them, where they can put their money based on what the government says is their Tier 1 restrictions? Whole life insurance, absolutely. It's called BOLI, bank-owned life insurance. We talk about it all the time. Look it up. Top 5 banks in this country as of 2019 had $75 billion in BOLI, in bank-owned life insurance, whole life insurance. Don't listen to any of these jokers on TikTok. There's one young man who makes really cool videos on TikTok, and he literally watches, he must be watching my videos and then just copies them, but then takes out whole life and implants IUL. Pisses me off. But anyway, whole life insurance is the only thing banks buy. No ifs, ands, or buts about it. And second, Ray got it, treasuries, treasury bonds. So Silicon Valley Bank, kind of just go back. When interest rates were low, Silicon Valley Bank had a lot of money. The government printed $5.2 trillion, injected it into the central banking system in various different ways. Banks got a lot of that money. Banks were flushed with money. So they're lending that money out at low interest rates. But to make money, what were banks doing with the surplus assets that they had? Buying treasury bonds. Why? Because they needed to. As people deposited money, they had to put 10% in something. And they also took the reserves and said, hey, where's a guaranteed place we can do it? Listen, Brandon right next to me ran a bank. And guess what the bank bought? Treasury bonds. He talks about it all the time. He's like, yeah, when we had excess money and we didn't have loans that we could put that money in, we bought treasury bonds. Right, that's what banks do. But you see, interest rate risk works in a unique way. You see, when the interest rates go up, the price of the bonds goes down. You understand that? So what happened? So banks in the heyday, 19, 20, 20. And you could go back to 2009 straight through, because that's when the printing press has been running full steam ahead. Banks took that money, bought treasury bonds. What price did they buy the treasury bonds at? High price. Why? Because interest rates were low. Interest rates low means bond prices are high. So then what happened? COVID, 5.2 trillion, the pandemic stuff. And then what happened after that? Inflation, over 9%. Most would call that hyperinflation. So what did the Fed do? Well, you already know this. Jerome Powell's been talking about it. Raised interest rates super fast, lightning fast. Within a year, they raised it almost 5%. So interest rates skyrocketed up. If Stephen were to show you a chart of interest rates, they went straight up. And when interest rates went straight up, what happened to the price of the bonds? They went straight freaking down. May I demonstrate what happened to the price of bonds here real quick? You'll see this in the 3-day. I'm just going to give you a snapshot. Let me show you Yahoo Finance 20+ year treasury bonds. There you go, folks. See this? This is a fun roller coaster. You guys ever been on a roller coaster where you're kind of going up? Oh, this is such a pretty ride. Honey, look at the birds. Honey, I can see my house from here. And then you look forward and you're like, oh shit. And then the first one, then it kind of hits that little thing. And you start, and then the big ride down. Why is this line down looking like that? It's because interest rates went up. But hold on. What happened right here when this thing was going up, when we were going up and saying, honey, look at the birds, look at the clouds. Oh, look at how pretty it is up here. We can see our house. What was going on? What was happening when this was happening? Price of bonds go up when interest rates are down. What happened during the pandemic? The Fed dropped interest rates close to zero and held them for a long period of time, for years, until they didn't. So now you can understand in real time, like what happened there. So when Silicon Valley Bank, was trying to sell and there was rumors that got out, people rushed the bank and taking their money out. You all know there's no money in the vaults, right? So when they're taking their money out, the bank started running out of liquidity. So the bank had to create liquidity. Where's the bank going to create liquidity from? Sell their bonds. Where did they sell their bonds? Hold on. Stephen, what year was that? Or I'm sorry, what month was that Republic and Silicon and all those went down? Somewhere right around here, right? So explain to me this. If you bought a bond, and these aren't the right numbers, but we'll just use these, at 169, at 163, at 138, but then
March.
March. So let's see. Let's go to March of 2023.
Yeah.
Boy, woo-wee, look at that. Oh man, where's March? Right around there. Okay. You paid 100 and something. Maybe you paid over par. You paid 106. Or I'm sorry, 160 for them, and then you had to sell them at 106. I'm just putting it into perspective. How big of a loss is that? Big. Enough to almost bankrupt like lots of banks. See, when one bank has a run, all the other banks, people get scared. They rush in. They want their money back. That's what happened. Now, this risk-free strategy you're going to hear about on the 3-day, we're not going to just explain it. We're literally going to show it step by step by step. And I think Craig on here might have some stuff we can kind of give you a glimpse into what we're going to show Friday, but not too much, just the tip. We're just going to show you just a little bit of it, okay? But here is the other thing I want to hit today, because this is going to be the sum up of so much of what we teach and so much of what we've been telling you is a simple thing. It's risk aversion. It's understanding your risk reward profile. Now, I know a lot of you are on here to learn about infinite banking. Actually, got 115 now. So this is a good time to pause. How many of you are brand new to the Wealth webinar? Put new in the chat right now. How many of you are here for the very first time? Put new in the chat. See, every single week we do this at the exact same time. We've been doing it for years and years and years. And every single week, so we got Martin new, Michael, Robert, Sam, Robert, Ray. I mean, every week we get new people to come on. So the new folks that come on, we don't always know where they're at. And then some of you never miss a week. How many of you never, ever miss a week? Dexter, you don't even need to raise your hand, but just put never in the chat. Yeah, Drew never misses a week. How many of you never miss a week? How many of you have this in your calendar to show up every single week, whether you can make it every week or not? I don't know, put lifer.
Me.
Yeah. So people get around this community, this campfire, and they never leave. And that's because it changes their lives. And I'm not just trying to speak to anyone on my team or myself. Like, we're just here to serve. You don't pay to be here. We don't ask for anything to be here. We don't sell anything. Although today we are going to probably try to sell you a ticket to the 3-day training. So just get that right out of the way. Okay. Because an hour and a half, I can't give you everything that I can give you in 3 days. So you're going to be sold a ticket to the 3-day. Fair enough? That's what you're going to be sold today. But we're going to give you a cool discount. We're going to give you some cool stuff. So it's going to be a really, really great offer. Fair enough? So real quick, before we get into some of the stuff that Craig's got, as Craig's working on it, I can already see his eyes. He's still working on everything he's got there. What I want to do is I want to show you a few things from a prior 3-day. You see over here, these are the boards that we create that I draw for the 3-day. And this one was pretty good. I mean, I can't believe I was able to draw that. That's actually not bad. But what I want to talk about is I want to talk about don't ride the bear, ride the bull. Okay. Don't ride the bear, ride the bull. Okay. Bullish, I guess. So bull riding is what you've been doing for the last 12 years. You've been riding the bull. The bull is the bull market. It's been the longest bull run in history, fueled by lots of printing by the Fed and Treasury, by lots of activities done by the government that promote, okay, everybody to spend money and finance things. That's why this country is in more debt than it's ever been in before. That's why car loans just surpass student loans. And that's why credit card debts in this country are higher than they've ever been in history. At a time when interest rates are, I'm not going to say higher than they've ever been, but at a very high point. So we've been riding the bull. But we all could probably agree that we're probably going to face some type of a downturn. Some of you are like, yep, it's going to be a doozy. Some of you are thinking it's going to be the next Great Depression. Some of you are thinking, I don't really know. I'm like 50-50. If you're the Fed, you think this is going to be a soft landing, but that's because you work for the Fed and because you got a printing press that literally has the ability to print unlimited dollars. However, even though you've got the printing press, when you go live saying your number one goal is to slay the dragon you technically created, which is inflation, and you won't stop until inflation gets to your target of 2. We're at about 4 now, maybe even, I don't know where we're actually at right now, but it's right around 3 to 4%. And we got to get down to 2. So more pain lies ahead. Pain being probably one more rate increase. Powell speaks sometime today. If he already hasn't, I'm not sure when he goes on, but mum is probably the word, and he's probably not going to do anything. He's just going to kind of do nothing. That would be my guess. You got this Israel-Hamas war happening over in Gaza, the Gaza Strip. You've got Ukraine-Russia war that's been going on for a while. And you got dude doing a dual proxy war. I mean, some things out there. Plus, you got an election coming up. Plus, you got earnings that are coming out almost every single day from all the companies that we love or hate. And all those companies are mostly all saying the same thing about the future. It looks bleak. We're lowering our guidance. We're lowering our expectations. We talked about this on WTF, What the F, this morning. I think it's safe to say, whether you either believe it or not, whether you want to hold them or fold them, this is coming. Let me just warn you of what that means, because so many of you, especially I need the newer folks, when you meet with your advisors and you talk to them about the things you're going to learn today, chances are what you're going to hear is, I understand we're very well diversified. We've got a great mix of equities, a great mix of bonds. We've got all these things. You're diversified. Okay, that's what they're going to say. And not only that, you know, the markets have always been positive over a long period of time. So you should stay in the market. You should ride it out. Okay, here's riding it out. This is you. Yeehaw. Okay, except for you're not on this part of the ride. You're up here. Okay, but here's what riding it out looks like. This is all I want to warn you about. Okay, this is all I want to prepare you for, is what does the ride look like? And I think this will sum it all up. This is what the ride looks like. It starts just like now, okay? So if you look at your statements now, many of you will see about a 10% loss, unless you somehow found an advisor or somehow you knew to pick just the Magnificent 7 in the S&P 500. Then you're probably positive. But if any of you are just the normal ones out there that are diversified and you didn't knock it out of the park and pick only the Magnificent 7 stocks, you are probably looking at about a 10% loss. Some of you are positive, some of you are negative. I'm talking about just for the year to date, okay? Not 10-year, not 5-year, year to date. Your advisor will always go back into time and say, oh, the 5-year, we're positive. The 10-year, we're positive. You know, they're always going to play in the past with average rates of return. And if I have time today, I'll show you what an average rate of return is. It's not what you think. It's smoke and mirrors. But if you lose 10%, all you got to make back is 11. So there's never any panic when you lose 10%. Most people barely even blip. They barely even break a sweat, okay? But at 20%, I want you to think back to the pandemic when COVID first started, and I want you to remember what the stock market did. That was about a 34% drop, if my memory serves me correct. When the market dropped 34%, how were you all feeling? Can anyone in the chat just tell me how you felt? Were you scared? Were your emotions running high? Were you starting to think, I can't lose anymore? Were you starting to think, oh my God, I don't know, this thing could go all the way down? Yep, loss. Like you were starting to freak out. You were really scared. Come on, give me your emotions, folks. These are emotions, not logic, emotions. How were you feeling during the pandemic when the markets were falling apart? Because I know how I was feeling. Well, I mean, part of me was excited because I was trading options, but part of me was also scared, like, how low can this go? Hope said I got out long before that. Great. Helpless and hopeless. Let's see. We all heard ride it out, but when it's too late, I love that test. Greedy. Okay. Okay. That's good. Mark was greedy. Let's see. In the market, happy I was not in. Sad for those who took a beat. Yeah. All right. So those are some of the different emotions, but that was only 20 or 30% off. Now, let me define. This is called the drawdown effect. I talk about this a lot, but very few people fully understand it, because when someone says, oh, I'm going to stay in it, I'll be fine. Somebody on WTF this morning said, you know, what if the market returned over the last 100 years? I said, number one, you're not going to live 100 years. I said, number two, the market was positive over 100 years. The market was positive over 50 years. The market was probably positive over 30 years. But you're missing the point, is what I always try to tell you. You're missing this. You're not taking into consideration. Anybody that tells me something like that, like, oh, the market's always positive in the long run, absolutely is. But you miss the emotion, the sentiment, which is the most powerful thing in the stock market. The most powerful thing in any market is sentiment. Sentiment is how you feel about something that happens to you. That's your investor sentiment. Your sentiment, when it's 10%, is not much. When it's 20%, is a little bit more. When it's 30%, holy shit. Guys, remember the movie National Lampoon's Christmas Vacation? Like he's doing that thing, and then at the end he says, holy shit. I said it wrong, but you remember that part. When it hits 40%, man, oh man, buckle down, get in the bunker. Like we're going, hell's freezing over, the world's ending. 50%, the world already ended, right? That's how we think. That's our emotions. That's our sentiment. So when people tell me, I'm just going to ride it out, it's just going to be a paper loss, which your advisor will tell you when it's too late. Your advisor will tell you at 30% or maybe 25%. It's just a paper loss. It's okay. We got to ride this out. We're diversified. It's just a temporary thing. Every recession's temporary. And then they give way to a bull market. We start pulling out of it. It's not that I'm concerned about. It's what happens in that sentiment, in that emotional period of time, which is coming, which is this period right here. 30% requires you to make 43% back. That's 13% more. So you lose 30, you got to make 43 back. People often don't understand this. So like, that makes no sense. It makes all the sense in the world. Because if you lost 30%, you have 30% less money, which means you have to have a bigger return on a lower pool of money to get back where you were. Exactly why after 2008, when around 2014, if I'm not mistaken, is when it happened, 13, 14, right after the Euro crisis, the markets got back to a high point. Like they went down from 2008 on, and then they got back to the same point. The news was all over it. The markets have exceeded the highs of pre-Great Recession. Yes, it's like clap. All right, yes, we're back. We're back. Woo! This is quite the ride, but we're back. But then all of a sudden their statement came in the mail, and they looked at their statement, honey, come here. What did you do here? I just watched on CNN just a moment ago that the markets are at all-time highs. What is going on here? We are still down 20%. What did you do? This is what my wife would say to me. And I'm like, honey, I didn't do anything. That's math. She's like, oh, here you go, blaming math again. It's math's fault. It is, honey, it's math. It's called drawdown effect. No. CNN, that gentleman just said that we should be back to all-time highs. And I just watched Dave Ramsey, and he said we should all be printing money because we are back higher than it's ever been. Kramer comes on and says, folks, I've got the greatest recommendations ever. Hits his bunch of bells, and all of a sudden you buy a stock, and what's it always do? Tanks. But anyway, getting off my high horse. You see, the drawdown effect, it's just math. If you lose 30%, you got 30% less, which of course it takes more of a return to get back to where you were. When you lose 40%, you got to make 67%. You see what's happening here? 30, 40% is critical. If you're not out of the market before it hits 30 or 40%, you are in for a very difficult ride back out. 50% game over, 100%. You lose 50, you got to make 100 to get back out. That's the drawdown effect. So I just can't understand why any of you, I don't care how risky you are. I don't care how much you know about stocks. I don't care how good you are. If you're an options trader, can I just put you off to the side for a little bit? Okay, but any of you that are just putting money in 401ks, brokerage accounts, or you got an advisor, you're not trading options, you're not a professional trader that understands how to manipulate down markets and up markets and sideways markets, and manipulate's the wrong word. But the whole point is the drawdown effect, you can't beat it. It will get you every time. The emotions that come into you at this point right here, the emotions will force you to sell, because it won't be a matter of, honey, it's just a paper loss. Hey, Jim, our advisor, honey, Jim said it's just a paper loss. It's going to be temporary. We're going to be fine. We're diversified, honey. Look at the portfolio he's got us in. And your significant other, your spouse looks at it and it's like, oh yeah, I see Jim's portfolio, and see that? Those are red. Those are negatives. They're all losing. What are you going to do about it? Honey, he said it's just a paper loss. We shouldn't sell. We shouldn't get out of it. It's not a paper loss. This is real. We have this much less money. How are we going to live? How are we going to retire in 2 years from now? How are we going to afford things when we have to take money out? Honey, it's just a paper loss. Just calm yourself. Like, what's going on? Did you wake up on the wrong side of the bed? That's when you hear the sound of something really hard hitting you across the head. Just letting you know. So don't push it that far. Wouldn't it just make more sense? Just hypothetically speaking, asking for a friend or telling from a friend, wouldn't it just make more sense to get out right around now? And then create a bridge, okay? Just put your money in, I don't care, let's just pretend it just gets put in a money market. Okay, let's play it boring, because money markets right now are paying almost 5%. Just put it in a money market account. Every 401k out there has a stable value or a money market fund. And if yours doesn't, ask why, because that would be sick. So you put the money in the money market, not all you do, you're sitting up on the bridge. All of you at one point or another in your life have seen a waterfall. You've been on a bridge looking over the pretty river underneath. Isn't it a nice sight? Some of you have bungee jumped just to test to see what this feels like, but you're like, nope, didn't like that. And you're about, actually, that's a good analogy, Stephen. I like that. Bungee jump. All we're going to do is bungee jump. We're going to be up on the bridge, and we're going to, hey, if you really want to test the waters, you want to see what it looks like down where all the other common folks are, you just put a bungee jump on and you jump and you go down and you're like, oh, wow, whoa. And you're back up and you're like, yeah, that was cool, but like they can stay down there, right? I like that analogy. So we're going to create a bridge, and we're going to look down from the bridge without any emotion, without any fear, without any oh shits, without any talks with the spouse of saying, honey, look at how much we are down. Look at this. It's only a paper loss. You're going to be sitting there. You're not going to be making a lot, but every month, every day when you look at your statement, when you saw the news, that guy on CNN comes on, or CNBC, or whatever station you listen to, Fox News comes on and shows you the reports of the market, and they're down 10, 20, 30, 40, 50%. You look at your statement, and all you see is green. Not a lot. Made 1%, 0.5% this quarter, but it's green. It's green. And you show your significant other, your spouse, and they're like, oh, well, at least we're making money. Yeah, Julie down the street, she lost everything. They got to sell their house. Yeah, they can't even afford food. And then all you do, without any emotion and without any knowledge of really anything, you literally just go and you grab some darts. And this is fun. You just print out a bunch of stocks. You don't even need to know what they are. And you're like, that one, I don't know what I don't even know what that company does. It says large cap. You just put them on the wall, right? You just put a bunch of them on the wall. And that's your diversification. All you do is you sit back, you blindfold yourself, you grab a stiff drink, bourbon or whatever your flavor of the week is, and you just start throwing darts. You just throw darts. Can't even see what you're throwing them at, but you get the whole wall just has stock, picks that you don't even know what the hell they are. And you just throw darts. They did this with monkeys. And then you take the blindfold off. Maybe you've finished your drink or not. You walk over and you take whatever ones your darts hit and you just buy them. But you buy them every month, a little bit. And this is your strategy. This is your dollar cost averaging strategy. Did you realize like you're going to crush it? Don't even need to get it right. Don't even need to get the stock right. Just don't throw darts at ones that, are on the verge of bankruptcy. I mean, that's the only real rule you got to put in there. But by dollar cost averaging into the stocks that you threw darts at in a declining market, you're always going to win. You're going to win. You might lose a little bit more because you're never going to get it at the bottom. But like, doesn't that sound fun? Or does actually staying in the market and worrying about this whole thing? And I'm not trying to paint a sad picture here. I'm just trying to get you folks to really see the magnitude of what could happen, because Stephen and I talk about this all the time. There really can be no other alternative. It cannot go higher. Okay. It can bounce around a little bit, high, low, but like if you look at the channel we're in right now, okay, the triangle, the V, whatever you want to call this, it is so narrow, we can't go anywhere. It's either going to break up or break down. And what's going to make it break up, folks? Tell me why would the market break out upward? What would drive the markets higher than they are today? Can anyone tell me? This is all stuff we're going to be covering in the 3-day, but in depth, but showing you actual tactical applications of what to do. Craig's G-Day. Okay. What else? What could right now, I mean, being honest, being sincere. It's 122 of you. I need you guys to participate a little bit here. Cash needs you to participate. Cash is my lazy kitten. World War III, war. Now explain something to me. How would a war make the markets break up? Actually, the exact opposite would happen initially. And then the latter part of a war, because a war is profitable, okay, which is sick, but that's called war profiting, or whatever you want to call it. If there's a war, that is not going to be good for the markets. It'll be actually tragic for the markets in the short run. Turn the printing press on. Go ahead, Stephen.
I don't think a war would be good even in the long run. I don't think we can handle it with the debt and the way the global markets are right now in the economy. But anyways, go ahead.
Oh, you're right. Okay, Willy, that's probably the best answer I've heard so far as to why the market would go up. Willy Wonka releases a new flavor. Yeah, that's probably the best one. Mark said, turn on the printing press again. They're not going to do that. Powell said that they're not going to turn the printing press on. Although in the future, I think they will, because when we are in a recession, that's when they'll turn the printing press on. That's when they'll drop interest rates, which is exactly why that risk-free strategy you're going to learn about Friday at the 3-day Money School Essentials training. That's what we're going to talk about, which plays exactly into what Mark just said. Greed. Who's greed, Derek? Whose greed is going to drive the market up? You and me? Okay, maybe. Institutions greed? Corporate greed? What does corporate greed require? Corporate greed requires people to buy. When people don't have money because they've been pinched for years against heavy inflation, rising food costs, rising cost of all goods and services, when margarine is up, I think it was 60-some%, when eggs are up 30%, there's the greed that is necessary to push the market higher goes away. So let's see what else we got. The best one so far is Joe's. Willy Wonka releases a new flavor. Currency wars, according to Jim Rickards. Okay, absolutely. I read that book, Chris. So he's talking about currency wars, which we very well may see. There's a strategy right now that is you'll hear about in the next coming months. The only reason I don't talk about it is you got to have $2 million. There's a strategy that exists that's currency. Okay, your money goes into an account. Think of it as a Citi bank account. Your money never leaves your account, but there's multiple accounts at Citi, and then you basically hire a trader, and all the trader does is moves money from one account to another account. One account is euro, one is the won, and one is the dollar, and all they do is on a very rapid basis move money in and out of your accounts. Your money never leaves your accounts, never goes outside of the United States. They move money into whatever currency. It's an algorithm that does that. There are traders that do this, but you need $2 million to do that. So if any of you have $2 million or have $2 million in a corporation that's sitting, oh, the other thing too, 24 hours of liquidity. So you need your money tomorrow. Like you use corporate money, and then tomorrow something happens and you need your $2 million back, you have liquidity in 24 hours. The money never left your account. So really 24 hours, why? Well, they just need to close the trades out. The money's never left your bank account. It's actually a custodial account, but your money never left that account. 24 hours later, you just take the money and move it into your Key Bank or your Bank of America or your Wells Fargo, or wire it or ACH it. This strategy, this has been around for a while. It's nothing new. I've known this guy, Stefan, in all of his different guys that he works with. They never really offered it to anybody like me, because it's just for institutions. It's for large money. They work with hedge funds and mutual funds and banks, and that's who they do this for. And now they've got a way. They said, hey, listen, if you got a client that's got $2 million or more, we could do this. So I guess I would say, if any of you have 2 million or know a friend that has 2 million, I could give you the contact for them. I'll put you in contact with them. So these things have always existed. Oh my gosh, somebody just said Trump. Okay, so sorry, Willy Wonka, you're out. I mean, I don't know, and I don't not know that if Trump got elected, if the markets wouldn't rally on sheer speculation of hope. I mean, if dude gets in again, I don't think that's going to be good. Let's see, stock market I'm just trying to look. Interest rates go lower, correct, hope. That's definitely something that would raise the markets, but interest rates are not going to go lower. I mean, when Powell goes on today, just listen to the minutes, just read it. It'll be on every news station. Political greed, Peter said, politician greed, that won't drive the markets. It'll just, if anything, probably do nothing different than what's happening now, because there's plenty of political greed out there. Let's see, set up IBC. Yeah, we definitely have IBC. Depression, Snoozeberries taste like schnozzleberries. Absolutely. That would drive the markets, man. I'd go all in on that one. Bank system could crash like 0708, switching to a new currency. Okay, so great answers. I think you all kind of see, like, some joking aside and some other things kind of discount, but like there's not much that can take the market higher right now. That's the reality. That's the logic. So if you know that to be true, then this is one of the simplest things you can possibly do. Just doesn't take us doing anything. You don't call us. You don't need to book an appointment with us to do this. Call your 401k provider, log into your 401k, find the one that says stable value or treasury bond or money market or cash account, and transfer out and keep existing new. Now, here's the thing. If any of you are still putting money in, so like when you're still putting money into the markets, like every week, bi-weekly or monthly, however you're doing your money going in, your new contributions, keep doing that into the riskier stocks, into your existing portfolio. I'm just talking about taking the gains off the table. And even if you don't have gains, because a lot of people recently have been saying, hey, Chris, like I looked at my portfolio and I don't have any gains. Everything's at a loss. Okay. How bad is the loss? Maybe now is a good time to cut it short, right? So remember I said losing 10%, because that's probably about where somebody's going to be today. If somebody's lower than 10, well, you definitely missed the magnificent 7. But, right around 10 for right now is about the worst I think somebody could be. If somebody's worse than that, I mean, we got to check a couple things, but you only got to make 11 back. Even if you're down 20%, you only got to make 25 back. This is the point of no return, I like to call it. Even if you're at a loss, folks, a gain or a loss right now is still one of the best times to look at doing this and getting into a bridge strategy. Call your advisor. Stop saying, I don't want to hear it's a paper loss. I don't want to ride this out. I'd prefer to just bridge over it. I'd prefer to just sit in a safe place. And then when the markets do whatever they're going to do, I mean, interest rates, right? Listen, the best argument right now for anything an advisor has to say is you can get 5% risk-free, everywhere, all over the place. Money markets, T-bills. I mean, where's my cash is sitting on my piece of paper, but cash, can I borrow this? I mean, right now, a 3-month T-bill pays 5.45%. Shut the front door. Do you know that a couple years ago, S&P 500 would have been happy to make 5.45? Usually an advisor, if he makes you 5.45, he's like, I made you money. I'm the advisor. I made you money. Like, they get excited about it. You can get that risk-free now. You do a 6-month T-bill, you can be at 5.55%. Risk-free. It's the United States government, like guaranteed by the full faith and credit of the United States government. So I'm not telling you to go into something where you're not going to get paid. You're going to get paid really well by all intents and purposes. You're beating inflation for one of the first times. Well, not inflation, but you're basically beating stated inflation. But what do they exclude from inflation, Stephen? Food and gas. The two things that really actually make up,
everything we use every single day of our lives. That's all.
So, I mean, who's keeping track? I mean, dude's definitely not. Dude doesn't remember what happened yesterday, but dude's not keeping track anyway. So I'm just simply trying to say, like, what you got to understand is you're going to get paid to do this. So you're getting paid to watch carnage happen, and then you just jump back in. You bungee jump a couple times just to see. You go bungee jumping could be you take a friend out for lunch. Say, hey, how things going? I know you lost your job. You're like, how's your 401k? Oh, it's that bad, huh? And that's bungee jumping. They're like, all right, well, hey, it was great seeing you for lunch. I'll get the bill. See you later. And if they ask you, how are you doing in the market? Oh, I don't know. I'd have to ask Jim or Jill, whoever watches. Just I don't know. Knowing that you're getting 5.45, 5.55%, you don't want to tell somebody that just lost 40%, you're making 5.55. Or maybe you do, because maybe you want to say, and you should do the same thing, but they're going to be like, oh, I wish I shoulda, I coulda, I woulda. Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up. So anyway, I don't want to go too deep into this and go too long on this, but the bridge, whoops, there goes the G-Wagon. The bridge is quite simple. You bridge the downside risk. You bridge it. You don't want to wait 12 years just to get back where you were. That's 2008. That's old news. Can't change that. People had to wait 12 years to get back where they were. You don't have to. They did. And they did it because of greed or FOMO or bad advice or just poor guidance. You are the best steward of your money, folks. Every one of you, not your advisor, you care more about your money than anybody, which is why we're always teaching you how to be the bank, why we're teaching you how to take back control of your money. We're not teaching your advisor, okay? We're teaching you because we know you care more about your money than anybody else does. Fair enough? Does anyone have any questions around that? If I offended anybody, it's okay. Not trying to make new friends. All right, Martin says, BYOB, bank, be your own bank. Craig, what can we show them about this? And listen, like tomorrow is such a fun day for me. You know what Craig and I get to do all day tomorrow? We get to work on just what's going to be taught, the entire thing that's going to be taught for Friday's 3-day money school essentials. But Craig, you wanted to come on. You look like you haven't even slept, man. You're that excited about this, man. You got like a little, little shadow. You growing a goatee out, or is that just because you've been so busy working on this?
Well, the whole thing's going to come in. So it's October is when it's beard season. I'll be out snowshoeing, and I'll need some face coverage. So I don't know. I might shave. You never know. We'll see. But yes, I did get some sleep, and I'm looking forward to tomorrow. So
can all of you kind of just envision? Just look at Craig now. In a month from now, he's got a full beard. He's got a beanie on. Like, just imagine like that. That'd be cool, wouldn't it? We're going to do that. It's going to be Halloween again. I think that'd be awesome. But yeah, Craig, I know you got snow on the ground. Now, I know you were the one that, were one of the only ones that could say, I got snow in my backyard. Not anymore. I woke up to snow in my backyard. So, hey, man, we're right there with you. So how do we kind of just give them a glimpse into this without giving them too much? Well,
one of the thoughts I had, you touched on the average discussion earlier, and I think it was two 3-day sessions ago, we talked about the average S&P 500 returns. Okay. And I was just kind of thinking it might be worthy of just touching on that real quick, and then we can kind of jump into what's coming up. But you might be surprised, but I've got a spreadsheet of all the S&P 500 returns from 1928. So
imagine that. As I'm like literally Googling, I see Steven over there typing away, Googling it, because that's what we do. And Craig's like, as you wouldn't be surprised, I got a spreadsheet. All right, well, here, let me give you sharing ability.
Yeah, if you want to share, give me the share. I'll go ahead and
you got it
out there. I know you're shocked. You're shocked to hear it, but I do have a spreadsheet.
Man, you put the extra hours in.
Let's see. Let me just drag this over.
I gotta get my 46-year-old eyeballs on. They call them reading glasses. Look at that.
Do you see the spreadsheet?
Holy cow, dude. Look at, so folks, real quick, and Craig, I got to let you take it after this, but it just blaringly obvious. 1928. Great Gatsby, all those good things. Look at the return. Craig, 37.88%. 1928. Huh, looks a lot, feels a lot like 2023. Feels a lot like 2022 too. If we had 1927, I bet you it'd been another stellar year. In the 1929, we all know what happened or started to happen halfway through, a little bit more than halfway through 1929. That there is the Great Depression. Mm-hmm.
Negative 25% average.
Which
so
isn't even all that bad.
Yeah, and almost just a quick query for the group here. So I've got the numbers from 1928 all the way down to, I think 2022 is where I stopped. Go ahead and put in the chat. What do you think the average return on the S&P 500 was from 1928 to year 2022? So we got Sean at 3%. Who else is going to wager a number? 5, 10 to 12. Well, let's find out. It's 7.6 something, but let's see what it is. So 7.65 average return. Not too bad, huh?
I don't know. That doesn't sound really all that exciting, Craig. I mean, 7.65, and we can get a guaranteed 5.55 right now for T-Bone.
Yeah, and I want to make sure. So Gladys made a point too, minus fees. So all the stuff I'm going to run through real quick, like, is it doesn't really consider taxes and fees. You might have a financial advisor that only charges you 1%, which is really generous. But, I'm not considering fees in this. Here's what I want to do. I just want to run through a quick example that kind of illustrates the whole average conversation. Because if we look at the entire S&P 500, we're at 7.65. But what I did is I kind of handpicked from 1970, let me see what year it is, to 1999. So let's go back here. Let's go find out from 1970 to 1999, our average return, 10.85%. That's pretty sweet. There are
Craig,
a couple
real
other.
quick, do you know that this is how they create those IUL, those index returns, like, you know, in the participating accounts, the index accounts? This is what they do. They literally have a group of Harvard grads go through and pick the best periods of time and run averages like you just did.
Yep. So there's another period, and I can't remember what it was, but I got about 11 point something. So anyway, you're going to get somewhere between 10 to 11 when you do a 15 to 20 year period. Okay, so this is pretty cool. Let's just say that you were working during the 60s. You accumulated $1 million in your 401k by 1970. That's pretty cool. That's good money back then. All right. Now I'm your advisor. Let's just pretend I'm your advisor. Hey, Chris, you know, we suspect that you can get about 10% in your market return in the S&P 500 over a long period of time, maybe 7, maybe 8. But here we are, fast forwarding, and it's 10.85. So could we project and say, if you had $1 million, then I'm going to get you a 10% rate in your 401k, so you can live off of maybe $100,000 a year. All right, well, let's take a quick peek. 10.85 is the average return, and this is what happens when we play with averages. If I have $1 million and I take $100,000 out that year to live, again, we're not looking at taxes and fees. If I take out $100,000, well, I've got 997, then I go down to 995. I'm pretty much maintaining my balance throughout time while I'm living on $100,000. So that's a pretty decent retirement back in 1970. Everybody think that's pretty great, pretty great, amount of money to live off of in 1970.
Mm-hmm.
I got bad news for you. Let's put the actual returns for every year against the S&P 500.
So the only thing you did is the one that you just did was average, like
Yep.
the average return, as an advisor always says, oh, the market has returned an average of this. And then you just replace that for what the market actually did.
Right.
Got it.
Unfortunately, you're not going to make it 30 years. You're actually going to run out of money in about 8 years if you take 100,000 out based on the average return. Well, we have a 0.1%, a 10%, a 15, then we drop 17, we drop 29. And what did we just hear with your drop down effect? If we're losing almost 17%, we've got to get back up to, I don't know, probably somewhere in the 22, 23%.
So yeah, I mean, if you lose 20, you got to make 25.
Yeah, so we have a 29, which gets close to that 30. That's 43%.
Yep. Yeah.
So now we need to get 43% to get back to zero here. But so anyway, we run out of money. That's not the greatest thing ever. So anyway, this is just a quick example to show average versus actual. We run out of money in 8 years. And guess what the average return was? Well, it was 2%. 2% in those 8 years. Well, anything else you want to add on this, Chris? I just wanted to show that average piece real quick. No,
and the other thing too, folks, you could pretty much do this and splice out any period of time anywhere, and the same results are going to happen because the drawdown effect. So to combat this, so Craig, I got one thing I will say, and I'll let you continue. So any of you that do decide to stay in the market, maybe you're super young, you're risk averse, you like trading yourself, you think you're going to be okay, do yourself a favor. If you have to draw an income from your investments, carve out at least 3 years, okay? Any 3 years. Take 3 years of your income, take that money and just put it in a money market account. Just have that money on the sides, out of the market, so that when you do need to draw down your account that is in the market, you don't take anything from the negative years. You only take from that drawdown account, which is a money market account that essentially can't lose money. That would be the only way around that, Craig.
Yep. Yeah.
May I suggest one of those stupid specially designed whole lives if you want to get a little better return on your money tax free?
Yeah, those are kind of boring, but
no pun intended. Yeah, I don't even know why I said that. It was stupid.
As Chris mentioned, we've got a lot of work to do for the 3 days, so I don't have a lot built here, but I think what we want to show is just a quick glimpse of what's coming. So Chris, you shared that chart of the bonds over time, the roller coaster ride.
What Craig is showing you here is something we've never had before, ever. We talk about it all the time in conceptual ways, but we've never had this tool until now. And you know how we're always saying in the 90-minute video, and if any of you haven't watched the 90-minute IBC video, the money multiplier method, Stephen will put it in the chat, but in there we do this really important section. Stephen does it better than anybody, where you're buying a car and you got a really good bank paying you 4%. And at the end, it shows you how you can make more earning 4 when you're paying 6%. So you're making 4 and you're paying 6, but you make more on the money that you're making 4 on. Most people say that's impossible. You're losing 2 by math. But because of the way the money works and math works and the way the velocity of money works, if one of them is compounding up and the other one is going down, then you always make money with a lower return. But here, what this gives us the ability to do is take away that guesswork that I'm always doing on the board of saying, oh, if your policy makes 5.2 and your loan interest rate is 5, you're making the spread between the two. And most people are like, it's not even worth the time. It's 2 basis points or 20 basis points. It's not worth it. But it is, because of one's going up and one's going down. This mathematically shows it. Sorry, go ahead, Craig.
No, I appreciate you kind of diving into that, because that's ultimately what we're talking about is, a lot of people will say, why in the world would I take a loan for my policy at 5%? Let's just say the interest rate is 5%. Well, Chris, are you really paying 5% if you take a loan and you pay it back and be an honest banker?
Nope.
All right. So let's just play the scenario out. You take $10,000, you put it into, those 20-year treasuries. And I think you had shared, was a 5.24? Was that the number you were talking about?
The bonds right now, if I average out the 3-month, 6-month, 12-month, 2-year, 10-year, 30-year treasuries and T-bills, you get 5.24% average yield.
Well, before I put that in, so that'd be $524 a month on a $10,000 investment, right?
Mm-hmm. Yep.
Well, let's look at the loan before we do any sort of repayments, because if we do take $10,000 out, guess what? We have a $10,000 loan balance. And the way this is going to work is there's going to be a certain percentage of interest getting accumulated every month. So the first month's interest is $42. The next month is going to be cumulative 83, then 125, 167, and on and on. Well, guess what? 5% of 10,000 is $500. So we are paying 5% on the money if we don't pay the loan back. So everyone follow and have that makes sense, right? Check this out. Let's say that we take the money that we're making out of those bonds and we just put it right back into the policy. So we're playing that scenario out that Chris talked about, where we're putting our money into a guaranteed vehicle and then putting it back into another guaranteed vehicle. We're not at risk here. So let's just say we're going to pay our system back $524 a month. All right. Well, in the first month, we apply that 524, 100% of it goes to pay down the principal, and then the interest gets accrued. So remember, when I didn't put anything in here, just take a look at this column, 39, 77, 122. I'm going to take this back out. Now it's 42.83. So the interest is higher when we're not putting anything back in. But now that I'm going to pay it down, I'm actually buying the interest charge down throughout the year.
And also, Craig, if they do this using their specially designed whole life, and they use the whole life as their banking system instead of a traditional bank, do they not have $524 to use as soon as they pay the loan down? Isn't that money
Right.
immediately available?
Immediately it goes back into your available cash value to use again. So we talk about all the time, Stephen, and you love to say this all the time, I want to take back control of my money, right? Woo. So when you put that 524 back into your specially designed whole life policy, that's available to use again. So if you wanted to pull it out, reinvest back into, the bonds and just keep recycling that money, you could. But there's some magic in the numbers. And what we're seeing here is that full 524 goes to buy down the principal balance of your loan. And so then our loan interest is less. So by being an honest banker, I'm just going to draw your attention down to this 330. Isn't our actual cost of money for that year 3.3%?
Yeah.
And I made it easy over here. I have this percentage rate that just kind of draws down. So the way this works is if you paid off the loan in full, these would be the interest rates that you essentially would be paying throughout the year. So our cost of money for that particular investment where we're putting 524 back is only 3.297%. That's pretty cheap money. We haven't built all this out, but there's two things we want to really show in this strategy. One is, what's the spread between the loan that you have for this money out of your policy and what did you gain in the bonds? It won't be huge, but it's guaranteed, it's safe, it's risk-free, right? So we're going to show that in the 3-day. We're going to map all this stuff out. We're going to show some different scenarios. So number one is, what is the loan spread? What's the spread between the loan and the bond, that you've got from your TLT or whatever you're investing in?
Yeah, because most people would look at the spread just from the surface as being, okay, I'm paying 5%, but I'm making 5.24. They think their spread is only 0.24, right?
Mhm.
That'd be the logical way of looking at it.
Yep.
But it's more.
So we're going to draw that out for you mathematically, but there's one more thing that's happening. What happens, and this is a question for the group, when we take that $10,000 out of our policy, how much of that is still compounding? 20%, 0, 50%, 100%? What is it? How much of this 10,000 is still compounding? 100%.
Got it.
All of it. Yeah.
We got it.
So guess what? There's another column that we have to show here to get kind of this total benefit of, well, how much cash value, and this is going to be dependent upon your specific policy and design, but we do have some growth in here as well. So isn't that all part of the mix? Yeah, it's all part of the mix. So we have the cash value growth going on. We've got the spread between the 524 that's coming in and the interest charge. So we're just going to map all this out. We're going to show a couple of different scenarios, but it's going to be fun. Lots of fun with math. To be done. I'm not done yet, but we're just giving you a quick sneak peek.
All right.
Okay.
Well, I just want to show the audience, if you could stop sharing real quick. I want to show you all how happy Lazy Cash is.
Wow. What a dancer.
Cash. I leave cash. That S&P sheet, we're going to be able to give that to the 3-day attendees. Is that right?
Yes.
Okay, cool.
But
So
the
anybody
other
that's looking for that
spreadsheet-
sheet, we'll hook you guys up with that at the 3-day. We're gonna get a little more about it, and then we can send that out along with the recordings on day 1.
Yeah, the other spreadsheets will all be available once we launch Done For You. So it'll be part of the Done For You program. And those spreadsheets, once they're completed, we're still working on them and we make them pretty and make them real functional. Those will also be available to be bought. You'll be able to buy individual spreadsheets that do unique things. They'll be very inexpensive, but there'll be tools that you can add to your tool belt.
Hey, Chris, I got a bunch of people signed up so far just during this. Francis and John and Lori and William and Tara and Tina so far from this webinar. I just want to show them the hat that they're going to get.
Oh, yeah. I forgot to mention, Shauna designed a unique hat, and a hat that is only going to be made for this event. So we're starting to do these like really unique one-offs. So this is the hat that everybody that registers today gets mailed to their house. So once who are the people that just registered?
So far from this, we have Francis, John and Lori, William, Tara, and Tina.
So all of them will get a box at their front doorstep with this hat in it.
We have 110 people signed up so far, so it's going to be a really good one.
The other thing too that people need to understand is, this is a virtual training, so you can do it from your house. And also many of you probably already this weekend have something going on. Maybe you've got weddings, maybe you've got plans, whatever it is. We do record a high quality recording of all 3 days. Then we have our editors go through and fully edit it and timestamp it. So what that means is they go through in each section. So like when me and Craig are doing this concept, this risk-free concept, that'll be one section. And then we'll have another section for, how to get equity out of your home without having to create debt. And we're going to have another section about, IBC going on blockchain in the future and how it will rival treasury bonds without time risk and without interest rate risk. That's the whole concept behind IBC, the policies, and using blockchain is it allows us to create an instrument that functions with the guarantees of a treasury bond without the risks of a treasury bond. So those are some of the things that we're going to talk about day 1. That'll be a section. And then all the other ones. I don't think we've ever gotten a bad review from the 3-day. We've never once. We always offer this. If any of you do the 3-day training and for some reason you don't make it, you don't want to watch the trainings after, or if you're just dissatisfied, I personally will give you your money back and you can keep the hat for free. Okay. So if any of you register for the 3-day and you don't like it, for some reason, something happens and you just can't find time to watch the recordings that you weren't able to be there live for, or you just don't like it, send me an email, contact@chrisnaugle.com, and I will refund your money. No questions asked, none. We can still be friends, not a problem. And you can keep the hat for free. So you get the hat, there's no risk. If you don't like it, can't watch it, or for some reason, maybe you just are like, you know what? That Chris Naugle guy's a dick. I want my money back. Fine, I'll give you your money back and you can keep the hat. So there's no reason you guys shouldn't do this. Zero. It's kind of like what we're going to be teaching. It's a risk-free solution. I promise you we will deliver. Nobody has seen what we're going to be teaching you. You kind of just saw a glimpse from Craig there. Nobody has seen any of the stuff we've been working on behind the scenes. And this one, I got to tell you, I'm excited about every 3-day. I mean, hence why I spend so much time creating these elaborate, drawings and all this stuff. But this 3-day, I'm telling you right now, I've never been so excited to dive in. I've got so much stuff. The only problem I'm going to be faced with for this 3-day is I'm going to be faced with not enough time to kind of get all this stuff out to you, but we will give you everything that we've got in us. And this is interesting, Stephen. I just pulled this up. So we've been talking about the inverse relationship between treasury bonds or bonds in general and interest rates. And look at this. This was done somewhere between 2022 and 2023. The yield on a 30-year bond was 3.9. Today, that yield is 5. I just want to kind of show you guys what's going on out there. This is actual real numbers. The yield is 5.068 as of yesterday. Let's just open this up because, you got the 3 of us. And I know we got Ask Me Anything this afternoon at 4:30. We stream live from YouTube, Facebook, and all the channels. We get the whole Brady Bunch on there, the entire team. But I just want to know, everything we just talked about today, what are some of the things that are on your mind, folks? I mean, how many of you are going to have a conversation with your advisor? Have any of you had a conversation with your advisor? Have any of you had your financial advisor actually call you and talk about similar things or about planning on how you can get ahead of what's about to happen? It didn't go well. Celeste, what happened? Chris Ash, that's typical. Most advisors don't call until you call them. They're not very proactive. I never was. I tried to be, but most financial advisors are dealing with few hundred clients, and there's just no way for them to do it. So they just rely on what they're taught. He didn't want to change to stable. Really? What was his excuse as to why he didn't want to change to stable account? That's an interesting one. Never had a call from my advisor. Wants to play with my money. The market is good. Oh, it's interesting. I'll give you a real story. So just recently, I was talking to one of my clients, been a long-standing client. She's got an advisor at Edward Jones, and she got on the phone, and she might actually be on here. And the advisor told her to get rid of the whole life insurance and told her that she should take the money from her specially designed whole life for IBC, which she's had success with. Just so you all know, she's been part of this campfire for a long time. She has the policy. She's taken the money out of the policy, paid off debt, recycled and recaptured the debt over. Then taken the money and she's lent the money out in PMC with success. But yet he said, oh, you shouldn't be lending money like that. You shouldn't be a private lender. That's too risky. And this stupid whole life, you're just paying for whole life. At the end of the day, you're just paying for life insurance, which you don't need. He told her, you don't need life insurance. Imagine this, Celeste. Imagine if I said to you, Celeste, you don't need life insurance. You shouldn't care about your family and your kids. You should not leave them anything. You should definitely not have life insurance. Why would you pay for life insurance, right? It'd be the same thing. First off, if anything ever happened if I told Celeste that and anything ever happened to Celeste, and that was a recorded call, or her significant other, spouse, or kids heard about this call where the advisor said, you should cancel that whole life policy and move it. And he told her, take the money from the whole life and put it into mutual funds, not into stocks, not into bonds, not into an ETF. No. Let's put it into mutual funds. One of the higher, and just so you know, this person, this client has 7 digits, okay, in a retirement account. So she's got plenty of money to only be playing in individual equities, individual bonds, or bond ETFs. It really doesn't need mutual funds, but that's what Edward Jones' advisor told her to do. Cancel your whole life, move it into the mutual funds, and oh, by the way, you don't need life insurance. She passes. And all of a sudden there's a lawsuit, and that advisor loses every time. or the markets crash and burn after that kind of a recommendation. Arbitration case, won all day long. That advisor has not a leg to stand on. Losing battle. And I still can't understand why people do that. They said, hold on, there's some good ones coming in here. They said, I'm too old for whole life policy at 55. Stephen and Craig, what does a whole life policy look like at the age of 55? You got any?
Looks excellent.
Too
got
old?
a bunch of them.
That's like the prime time. It's like, oh my God, it's like prime time. 55, too old.
Yeah, whoever told you that, not correct.
Hold on, I got to keep going while you guys. I know now Craig is all over spreadsheets. Let's see. If I put everything, including real estate rental business, into a trust, how can I get additional life insurance? No W-2. There's it would be done, Brad, we just have to do a cover letter to the insurance company explaining that. We might have to show them the trust assets. So normally if you got a trust, you're going to still have a balance sheet for the trust and the assets that are moved into the trust. That's still reportable, and you can still show that. Even though you don't technically own it, because the trust owns it, they'll still count that 100%. I can speak for myself. I mean, I own basically nothing. I own 1% of all my entities. I have a tiny little bit of money in bank accounts, but the majority of my money is in whole life and in trust assets. So yeah, I wouldn't worry about that.
Yeah, we just did that with another client. It's just a cover letter and maybe a report from a CPA or something, but it's real easy to do.
So I said, I didn't tell my advisor, didn't want to hear the crap. Sometimes it's just not worth the time, right? Ain't nobody got time for that.
Ain't nobody got time.
If either of you find one for 55 for Tina, that's interesting. 67. Yeah, there we go. Morgan said, I'm 67 and have a great IBC policy. Oh gosh, 63 and I have one, 62, and it's been the best thing I've done. Thought you were 40.
I will find one. I know I've got some. I just need to
I
hide
got
names
so
and
many.
such.
That's the problem. Here, I can't. Let's see if I might get lucky. So anyway, how many of you are coming to the 3-day this weekend? Because we only know the people that have signed up today, but how many of you are coming that maybe we don't know about that?
We just got a
your
bunch
ticket?
more.
Oh, did you?
Yeah, so let's see. Tina, I said Sarah. So Sarah, see you then. Lionel, fully love. This is multiple for you. Michael Turley, multiple for you, I believe. Deborah, Rod, Michael Globitz, all are in and have hats on the way. So congratulations.
What was the one? Michael Globitz? Yeah, Michael, if you're still on, do you have any relatives in Lockport, New York? I grew up with some Globitz. Or some of my parents' really close friends growing up. Yeah, I don't have one as an example on here. These are 40s, and anyway.
Yeah, I know a lot of you signed up last week also. I'm just calling out the ones that just did right now.
Yep. You know, another thing too, this morning, I had a good friend of mine here. I talked about this in WTF, but a good friend of mine called me up and asked if I could meet, if I would meet him for coffee. And he's big into real estate. I would consider him a very high net worth individual just from the surface of knowing him. And, he had a big lawsuit many years ago, lives in my neighborhood in a 7,700 square foot mansion. I mean, it's a surreal house, drives really nice cars like Audi Q7. So I'm meeting with him and, he's talking about all of his Airbnbs and he's got a couple places in Ellicottville for like skiing with his family. And I'm just like, yeah, dude, you're crushing it. But then like, he starts to tell me, he's like, the reason I wanted to meet with you, because we get past the small talk, and he's like, the reason I wanted to meet with you is I read the book, Becoming Your Own Banker. And I said, okay, and what'd you think? He said, this can't be real. He said, this is what you do, right? And I said, this is all we do. And he said, is it real? Does it really work like that? And remember, he read the 5th version of Nelson Nash's book, and he was beyond intrigued with the equipment financing. And how he looked at the equipment financing is he parlayed it and said, okay, if it's not equipment, can it be real estate? Can it be Airbnbs? Because that's what he's big into. And he's like, it really works that way. And he says, not only that, like I have no life insurance. He's a broker, like a real estate broker, so they don't really have any benefits and he really has no life insurance. So we're just going through this whole thing. And then I just said to him, I said, so, you got all this and I'm sure you got some debts, right? He says, oh, I got a lot of debt. I said, you mean the mortgages on the real estate? Because I don't consider mortgages on real estate always bad debt. It's debt, but it's not bad debt because he's producing income. And he says, oh, I wish. Actually, that's another reason I wanted to meet with you because, I know you used to be really in debt. He's like, I remember when you and Larissa were doing all the real estate, I would hear from various people and bankers that you guys were highly leveraged and really in a tough place. True statement. And I said, absolutely, we were. Some days I didn't know how we were going to get to the next week. And he says, yeah, well, that's how I feel. And I was kind of baffled. I'm just like, whoa, really? I would have thought like, you're just sailing. And basically we kind of got into it. I'm not going to give any specifics or names or anything like that, but he showed me a spreadsheet and I was blown away. It was like over $200,000 in credit card debt and it's super high interest rates. And then I just asked him, I said, because he didn't have the dollar amounts he was paying on these credit cards. I said, is it over 10 grand a month? He says, yeah. And I said, I know you make a lot, but what's going to happen? Like, the National Association of Realtors just got sued for like $1.8 billion. Is that going to affect you? He's like, I would have to believe. Plus the market's slowing down. He's like, I got properties that have been sitting on the market for months. This is the first time I've ever had that in a long time. He says, like, yeah, so things are slowing down. He says, I got a couple of properties I'm selling. I was going to use the money from the sales to wipe out this debt. And I've done all the math, see right here, and I can take all this money from the sale of all these things and I can get out of debt and sleep at night. And I said, don't do that. All right. Like, most people would be like, why would you ever tell somebody not to pay their debt off? No, don't do it that way. I said, there's a way better way to do this. I said, what if all we do, you just read the book. What if we just took that money, we put it into the specially designed policy, we immediately take it out and we structure using tools that we have that Craig has created. We structure the absolute best way to pay all that debt back. I said, you'll be able to first get paid on $250 some thousand, because that's the amount of cash he was talking about, on $250 some thousand for the rest of your life. Plus, we'll pay all the debt down and then we'll pay the policies back. And it won't even be any different than what you're doing. You won't have to make any more money. Matter of fact, you have to make less than what you make today. You're already saving money because he showed me how much he saves. Said you're saving money. You've got all the sale of these things. Here's your commissions you're making. And you've got this debt. The debt's keeping you up at night. I said, this is not a problem. But folks, like me looking across the table at this person, you got to understand, like, and maybe it's a Buffalo thing, but like never would I have thought this human being was in that situation. How many other people that you meet, that you talk to, only tell you the good side of a story? How many of the people that we come across day in and day out that act like they've got it made? They drive the fancy cars. They live in a mansion. They've got their wives or whatever, their husbands, like wear all the fanciest, most expensive clothes. They got the Rolexes, everything. And then when you find out, like they're buried in debt, it just makes you think how many people are in that scenario. I bet you some of you on here are thinking and like, that's me. I'm not going to tell anybody. Right. Don't tell anybody, but tell us. Get on a call with us. Stephen, put that 90-minute video with the link. Call us and we will literally show you how to erase all your debt without having to work harder, longer, or take on any risk. And we'll show it without changing any of your cash flow. You won't have to change your cash flow. Craig, how many freaking times do you do this a week where you show people how to eliminate debts or do what they're doing without changing anything? You just reposition where the funds are going and then you put a process to it.
Several. I mean, I did probably 3 yesterday and I'm working on 2 today. So,
and that's one money mentor, folks. Stephen, I don't even know how many money mentors we have now. Like how many of these conversations?
My emails, put it that way.
Yeah. How many of these conversations are happening every single day with different people around the country? This is a problem that the hardest thing for all of us, me, Stephen, Craig, this entire team, Shauna, all of us, the hardest thing for us is that people don't allow us the opportunity to help solve their problem. We're not asking for anything because the first thing Tim said is, oh, what does it cost? I'm like, what do you mean? What does it cost? He's like, well, what's the membership into the program? So what program? He says, I don't know. I was on something and I thought it was like $1,500 a year. I said, that's Private Money Club and that's $1,000. Just get on the phone. 833 join PMC. Get on the phone with them and they'll help you. But like, he's like, you don't charge for this? I said, no. So we give our best stuff away for free. He's like, how do you make any money? And I said, well, nickels and pennies, man. We make a nickel here, a penny there, a dime there. Little commissions on thousands of people. I don't know for a fact right now, but I think we're almost about to turn over the number 8,000 clients now. We do about 400 people a month that we're helping. It should be 4,000 a month. Some of you are like, oh my God, that's a lot. No, we're just getting started, folks. We're just warming the engines up. The engines aren't even warm yet. It's like when you first start your car up and the choke's on and it's kind of, well, maybe that's Aaron's car with the big cams, but you get the point. Like the engines just started to get warm. Like we're just getting started here, folks. You guys are all the ones we want to help, but we want to help your friends, your coworkers, your families. We want to help all of them. The difficult thing for us is people are not getting out of their own way. They're scared to talk about the things that hide behind the curtains. which is the debts. They want everybody to think everything's rosy and perfect, but it will be too late soon for those people. We can't save them all. We can only help the 5%. You are all the 5%, folks. And those of you that join us for the 3-day training this weekend, this Friday, Saturday, Sunday, from 12 to 4 or for 10 to 4 o'clock Eastern, or just watch the recordings and the stuff you want, cherry pick it. Like, you are like the 1%ers. So there's the 5%ers that are on the wealth webinar every week, or all of you new folks that joined us. Thank you for your time. But it's the 1%ers that join us on the 3%. Those are the ones we really get to do deep dives. And those are the ones that no matter what, like we end up changing their lives. And I'm not beating our chest or patting ourselves on the back. We're not fully responsible for changing your life. You are. It's not us. We just show you the path. We give you the tools. We give you the spreadsheets, Craig would say. We give you the, the ability to get the policy done the right way. That's all we do. We just give you the path. We just literally point you on the path and say, there it is. It's been in front of you all along. I don't know why you went over there and jumped off that cliff and went through that river. I'm surprised you didn't get eaten by that alligator down there, but like, there's the path. It's always been there. I don't know why you didn't see it. It's kind of silly for us. Like, we're like, why didn't you see this? Why did you miss this? But it's okay. It's all this is. So don't, give us too much credit. And I always say that to people, like, yeah, we're here every day. The biggest credit you could give us is just the fact that we show up every day. We show up for you every single day. Whether it's snowing, sleeting, tornadoes, earthquakes, what other things have we shown up on? Blizzards,
Fires,
cat bites, cat scratches, flus, sinus infections, almost not pneumonia. We show up, folks. That's the only freaking thing we do, is we show up with the guidance. We've got the GPS that you don't have. So folks, I hope you all join us this weekend for the 3-day training, where we can really open the door to your future. And I mean that with the whole, like, from all of my heart. I know Craig does. I know Steven does. We'll put the link up one more time, folks. Put the link up. So if any of you want to get in, get your free hat, I don't even care. Like, hell, sign up. Some of you are on here and you're like, man, I think I'm just going to sign up and then I'm going to ask for a refund so I can get that hat. Go ahead, do it. Make my day. Because you know what? You do that. All I ask is if you do that, because I don't care, sign up and refund. And wear that hat. That's all I ask, because somebody's going to ask you about that hat, and you're not going to be able to tell them anything other than, yeah, it's this guy, Chris Naugle. He does a webinar every week, in this 3-day training, and they're going to go there and we'll help them. We'll serve them, but you get the hat for free. So that, I don't think you're going to find many people that would tell you that. I don't think you would. And I can say that because I know you won't do that, because you'll show up. You'll be the 1%. You'll learn something you've never seen before in your life, that much I guarantee, and you'll apply something. Maybe not everything you learn, but you'll apply something, and that something will change your life, your family's life, and your kids' lives. And that is powerful. So with that being said, Stephen, anything you wanna do a final call out to all the people that joined in today?
Hats incoming for Francis, John, Lori, William, Tara, Tina, Sarah, Lionel, Michael, Deborah, Rod, Michael, Virginia, Michael, and Sharon. So congratulations, guys. Y'all got hats coming your way.
All right. Congrats to you guys. Thanks for taking action. It's the action takers that get what they want out of the future. So with that being said, folks, we'll see you this afternoon at 4:30 Eastern for Ask Me Anything Happy Hour. If you don't know how to get there, just go to my YouTube channel at The Chris Naugle, subscribe, click the little bell, smash that bell, and you'll be notified right before we go live. With that being said, folks, thank you all from me, the whole Money School, BYO, Money Multiplier, and PMC team, and none other than the Lazy Cash. See you guys next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.